overall, the reason that those assets continue to surprise to the upside is because of that fiscal backdrop. If you were trying to short assets in an emerging market in a local currency, you're going to continually get headwinds from the fact that that currency is so weak, right? It's just that currency is going up in supply so quickly that the assets that you're denominating them in might not be doing great in real terms, but they're certainly doing fine in that local currency term.
Fan favorite Lyn Alden, founder of Lyn Alden Investment Strategy, returns to the show to share with us the asset classes that she's most bullish on for the remainder of 2024, what she thinks will happen to gold, Bitcoin, and stocks for the remainder of the year and into next year, why she thinks inflation may not come down to the Fed's 2% target anytime soon, how the Fed will likely respond to this new inflationary dynamic, and why fiscal dominance is so important right now. And we'll discuss exactly what this means and why the government is spending so much money and the consequences of all this fiscal spending. First, a word from our sponsor, NordVPN. You don't want to miss this episode. On this show, we regularly cover how to grow and protect your assets, but one of your most important assets is your privacy. Every investor needs to protect their digital privacy and footprint against hackers and potential viruses. According to Chainalysis, 2022 was the biggest year ever for crypto hacking, with hackers stealing $3.8 billion in cryptocurrency. And according to Duke University, more than 80% of U.S. companies claim to have been successfully hacked. One of the best ways to protect yourself and your privacy online is with NordVPN. Not only does NordVPN hide your identity online from malicious actors and criminals, but it also comes equipped with malware protection. NordVPN also prevents you from accessing dangerous websites, allowing you to enjoy your favorite financial content securely. And the best part is that it is easy to use. Just download and click. NordVPN is available for your phone or computer, and they're currently offering 65% off on a 2-year plan plus 4 extra months. Simply click on nordvpn.com/DavidLyn in the description down below to learn more. Lyn, welcome back to the show. Always good to see you.
Always happy to be back on. Thanks for having me.
Felt like yesterday when we last spoke, but really it was November, so lots has happened since 4 months ago. I like to start with current market action. Stocks, gold, and Bitcoin have all moved up. I think investors would first and foremost like to ask you which assets you think would be something that should be overweighted for the remainder of the year.
So for this year, I'm bullish on Bitcoin, gold, energy. That's kind of the big areas of focus for me at this time. Bitcoin's already had a lot of powerful price action, obviously, earlier this year. So I think now it's consolidating a little bit. But, over this year and next year, I'm bullish on all those assets that I mentioned. And of course, it depends on what their capital mandate is. So, energy is cheap and profitable and has good balance sheets generally. Gold and Bitcoin are kind of alternatives to treasury bonds or alternatives to tech stocks, for example. They can fit in a portfolio in that context. And so those are kind of the assets that I find attractive at the current time.
Would you say that valuations are a concern for you at current levels for all of these assets?
So I think that large cap growth equities have valuation concerns. So, for example, large profitable tech companies, even companies like Costco, for example, they're very highly priced relative to their fundamentals, relative to their growth. Basically, it's not a problem necessarily with the companies themselves. I mean, Costco is doing amazing. It's just that investors are really crowded and really kind of piling into them. So I do have valuation concerns for those. I don't really have valuation concerns for energy, for certain ends of the value spectrum, for some of these smaller companies, nor do I have valuation concerns for gold and Bitcoin. Instead, it's just a matter of that sometimes they can get euphorically overbought in the intermediate sense. So that's something I look out for. But other than that, I think that those areas are still not very crowded in terms of overall investor portfolio positioning.
Just today, as we're speaking on Tuesday, this week earnings are starting to come in. Some of the results have been disappointing. Indeed, the Dow is dropping. Stocks are dropping today as we speak. The S&P is down 1%. The Nasdaq is down 1.3%. The Dow is down 400 points. Some have told me that weak earnings are to be expected as we head into what may be an economic slowdown or some sort of contraction. Do you agree with that view?
So I think you have to be sector specific. I think that's been the challenge. So over the past, call it 18 months, we've had a PMI, a Purchasing Managers Index below 50 for like a year and a half. And so that's already been recession-like conditions for certain industries. And of course, commercial real estate's been in a depression-like context. Whereas some of the more service-oriented businesses out there, tech, there's other areas that have been in recovery mode. And so I think that some of that could rotate in the sense that some of the things that have been doing really, really well could increasingly show some weakness ahead, whereas some of the things that have already gone through that down cycle, and if anything, I think some of them are recovering. I expect probably higher PMIs by the end of this year than we started the year at. And I think some of those more cyclical things could follow that. So I think that question of slowdown versus not slow down is very sector specific. I think instead it's more of a rotation, a reacceleration, some of those things, even as some of those bigger tech things do slow down.
I think the slowdown may or may not affect sentiment. What do you think? Do you think risk on sentiment, which has obviously been the case for the last 6 months, could reverse over the course of the year?
So I do, but I think that even some of the action we've seen is indicative of not super bullish sentiment. People don't pile into Costco at 50 times earnings necessarily purely out of bullishness. Some of that is because it's actually a form of defensiveness. It's saying, I don't really want to own bonds per se. I want to buy a really blue chip company and I'll crowd into that rather than owning any of the things that are more cyclical, the energy names, the banks. That's the capital flight out of there, I think, has been indicative of risk off behavior. And so I don't view that the current period we've been in as super risk on. And instead, it's more indicative of fiscal dominance, indicative of how many other areas are perceived as non-investable. And I think what we could see is a broadening out of what is perceived as investable, right? So some of the risk sentiment could actually increase for some of the things that have been considered too risky. Whereas some of those things that people crowded into, I think people could get quite concerned with the level of valuation there relative to the growth numbers that are coming in. If you've seen, for example, Apple and Tesla just not putting up amazing numbers. And the problem is that investors had overpaid for relatively spectacular results that they're not getting in the fundamental data.
Yeah, so sector specific, then, well, the obvious follow up question is which sectors are you most bullish on and least bullish on?
So I generally like industrials. I like energy. Energy, I think, is the more attractive risk reward. And I think with financials, as long as you kind of avoid the commercial real estate concentration, I think most of that is decent at the current time. I think those are. I think even for example, the midstream energy sector, for example, that's been showing signs of breaking out. It's kind of new post-pandemic highs, let's call it. And they pay you very high yields while you own them as well. And so I think that there are a bunch of investable areas, and that the market has largely not wanted to touch those, and that those are, even at the current time, presenting opportunity. Now, when you get kind of overall risk off sentiment, bad days, you can get capital pulling out of those as well. But basically, by being cheap and having good fundamentals, they somewhat limit the downside, and then they pay to own them. So even if the upside takes longer to come to fruition, it's still a positive carry asset for many of these while you own it.
You mentioned commercial real estate, something we should stay away from even today in April 2024. Why is that?
Well, I think that if someone is a professional commercial real estate investor, I think that there are going to be opportunities, right? Obviously going to be bargain hunting, like super cheap opportunities. But in general, I think we're seeing just an ongoing slow motion train wreck in commercial real estate. I think there are more losses coming. I think that lenders that are heavily exposed to commercial real estate are likely to continue having problem. I would say a lot of that's already priced in. A lot of that, a lot of those things are already super cheap. Capital, it's a very well known theme at this point that commercial real estate's in trouble. And I think that a theme I've been making is that so many people keep saying that commercial real estate is going to drive the next recession. Whereas what I've been pointing out is even the bearish assumptions are looking at, say, like 1.5 trillion in equity wiped out of commercial real estate. Whereas if you look at fiscal deficits, they're over 1.5 trillion per year. And overall household net worth is something like what, like 140 trillion and rising at all-time highs, right? So there are these pockets that can do really badly, and that, if you're exposed to a bank that has a disproportionate amount of lending to commercial real estate, for example, there still could be more shoes to drop there. But that if you're in areas that are not really in that area, if you're in energy, if you're in other types of finance, if you're in other assets in general, even certain emerging markets, those can I think continue to reaccelerate out of their kind of pandemic lows, while these other things continue to suffer because we're in this environment of kind of structural fiscal dominance. It's very hard to have a recession when you're pre-stimulating to the tune of 1.5 or $2 trillion a year in fiscal deficits. And it doesn't mean that's not necessarily a good thing. But it's a different reality on the ground. A lot of it is kind of like an emerging market where you have to separate nominal expectations from real expectations because you have that underlying kind of fiscal unsustainable backdrop. And that just changes what investments make sense in a nominal sense.
I do want to come back to your fiscal dominance theory, as well as some of the asset classes that you mentioned in particular, specifically. But first, let's sum up your overall market outlook before we move on to that. So, bottom line, are you expecting some form of a broad market in equities, at least, correction later on this year, whether it be a result of an overextension of prices or a result of some sort of recession?
I'm not, the answer is I'm not sure, but I would say that I would expect some rotation, which is to say that to the extent that I want to protect myself from that risk, I would not want to own the over-owned things, or at least I would not want to be overweight the things that other people are overweight. I would either want to avoid them or downweight them compared to other things that people have already written off that people are not crowded into, because even if we do get that correction, I'm not sure that it would impact those other assets I'm referring to.
Okay. And speaking of rotation, are you expecting any more capital to rotate into the fixed income market? In other words, how do you think interest rates will affect the broad fixed income or bond portfolio?
So I'm neutral on those. I do eventually expect to see a curve steepening either because the front end's cut or because the long end rises a little bit or a mix of both. And so the overall risk reward of the long end is still not super attractive to me. To the extent that I like bonds, I either like T-bills or I like intermediate term tips. For example, I don't particularly like the long duration bonds, which is not to say that I don't think that they will, it's not that even if they squeak out gains for the year, for example, there are much better other assets that I'd prefer to own from a risk reward standpoint. I prefer to own things that I view as asymmetric, meaning that the downside is relatively contained, whereas the upside has a lot of room to go. And I don't view the bond market in that situation. I wouldn't be surprised if we see yields higher or lower by the end of this year, but it doesn't feel like it's weighted toward a kind of a strong long outcome. So it's just an area that I kind of put into the too hard pile and say that it's not a lot of opportunity for the amount of risk I take on.
So if you expect the yield curve to steepen, I'm assuming then you expect the long end of the curve to continue going up, even if the Fed cuts, which would bring down the short end of the curve. Is that correct?
Yeah, or it stays sideways while the Fed cuts the short end. There's a couple of different ways and magnitudes that could happen. And to the extent that long end yields stay higher than expected, that could put pressure on some of those highly valued equities that we just talked about, right? So I think the bond market's already a little worried about reaccelerating inflation, where we haven't really seen that in the large cap equities yet. I think that they've still discounted the possibility of reaccelerating inflation, and so some of that's potentially not priced in. And so those crowded areas might not, they might correct or at least stagnate for a period of time if they come to fully realize that the long end yields are maybe not going down as quickly as some investors expect.
Are we having reaccelerating inflation, Lyn? I mean, the latest CPI numbers have not fallen at all since the previous months. However, they haven't substantially reaccelerated, at least on paper yet. So please elaborate on what you mean by that.
So I think we're seeing stabilization of inflation, and the step before reacceleration is stabilization. So if it's not going down, that's a sign of a potential bottom. Um, and one of my themes for a while is that this decade will be more inflationary than the past decade, but it won't be a straight line. It'll come in waves, as most inflationary decades do, and that those waves will generally be correlated with economic acceleration or deceleration, especially some of the more energy intensive areas. And so, for example, PMIs, like we just talked about, have been falling and for a while. They then have been stabilizing for a while, and they're actually showing earlier signs of recovery and reacceleration. And I think inflation could follow that with somewhat of a lag. I do think if we see a continued PMI upcycle, that could come with a little bit of inflation. So it's not like I'm forecasting inflation to quickly retest the highs we saw, a couple of years ago. But I do think that the Fed's it's going to be sticky. It's going to be basically inflation's not going to go down to the Fed's target as quickly as they'd want it to. And that inflation, I think, is going to hover 3% or higher, most likely. And I think the key thing to watch to see if it can go much higher than that is energy. I expect rent inflation to kind of stabilize, not really trend lower, but not necessarily explode higher either, because there's a lot of supply coming online. But it's really the energy markets that I think are worth watching to see if we end up having above, like inflation that's even above kind of current levels that are already elevated relative to targets.
So the Fed, how would they respond to this stabilization of inflation, you think?
I think neutrally. I think that they already kind of realize that their tools are not necessarily well positioned to deal with this. So when I talk about fiscal dominance, what I refer to is when we look over let's call it, I did charts on this. Like, for example, the past 70 years, if you look at where most credit creation happens, right? Mostly it's in the private sector. So, for example, if you sum up net new bank loans and net new corporate bond issuance in a given year, that sum is usually bigger than annual fiscal deficits. So that's kind of private sector, Main Street credit financing. And for the most part, that's bigger than annual fiscal deficits. But one thing we've seen in recent years is that fiscal deficits are bigger than those combined, right? So there's more kind of nominal power coming from the public sector than the private sector. And that has a couple implications. Basically, the Fed's main tools are around modulating the speed of things like bank loans and credit issuance. If they want to try to slow down inflation, they try to raise rates or do quantitative tightening to try to slow down that private sector activity until they get, either a recession or a near recession. And the problem is that in the current era, because the deficits are mainly, it's mainly a fiscal driven large deficit phenomenon, that's where the inflation's coming from. There's only so much that they can slow down that private sector. And a problem is that, back in the 70s, for example, or the early 80s, when they wanted to try to control inflation, they had very low public debt. And so if they raised rates, they could slow down that private sector credit creation, and that would have a bigger negative impact than any sort of increased public interest expense they would have from those policies. But if you fast forward to the current time, instead of 30% debt to GDP, there's 120% debt to GDP. And so when they raise rates super high, it does slow down that private sector credit creation moderately, but then it completely blows out the public interest expense and overall fiscal deficits by an even larger number. And so they're not really able to slow it down to the extent that they would be able to if they were in a lower public debt environment and where most of this was coming from that private sector. So it's really about not having the right tools to address it directly. And I think that, they've been kind of been acknowledging that, even just not directly. So I think what you would generally see is they'd probably stick at relatively high interest rate levels. They probably would not aggressively raise them more. They might focus more on curve steepening because that's a way to, moderate costs for the government, while keeping higher interest rate pressures on the private sector, mortgage rates and corporate bond rates and things like that. So I do think that they might start targeting curve steepening. But I think it's mostly about just expectation management. I think they're going to be relatively neutral, even if inflation reaccelerates. And I think it's going to be an ongoing kind of narrative issue for them.
Suppose energy moves up and accelerates there and brings inflation up with it. Do you think the Fed may respond by raising rates again?
So it's possible. My base case is they would first focus on higher for longer, rather than raising rates, because I actually think that the raising rates beyond a certain point can actually be stimulatory. That's the challenge you face in a fiscal dominant environment. So if most of the money creation was happening because of the private sector, then higher rates would generally be not stimulatory. The opposite, it would be depressionary. But because a lot of this is fiscal driven, and that's interest rate, it's not sensitive to interest rate. The spending, the taxation, it's largely not sensitive to interest rates. And so by raising rates, they actually just increase the deficit more. And that's where a lot of the stimulus is coming from. And so, they might turn to rising rates, but I think it would be ineffective if they did. Instead, they probably will just kind of keep it high, and we'll see if they try to rotate the yield curve to be steeper. That might be one of the more optimal approaches. But really, it's I'm less concerned with what the Fed's going to do because I don't think they're in the driver's seat. I think the fiscal side's more in the driver's seat, and I think that the Fed's going to kind of move around whatever the fiscal side's doing.
Let's talk about this fiscal dominance that you're referencing. So, first of all, what do you mean by that exactly, and why do you think there's so much fiscal spending, or just spending overall from Congress right now?
So for the first one, fiscal dominance is basically when, you know, so monetary policy is things like interest rates or central bank balance sheet. Fiscal policy is like taxing and spending decisions by the government. And fiscal dominance is when that latter has a much bigger impact on the economy than the former. And more specifically, it's when the former, whose tools are meant to control inflation, are no longer able to control inflation because most of their tools are geared toward the private sector, whereas much of this is happening from that fiscal side, from the public sector, and central bank tools don't really address the fiscal side. Another way of putting it is that in an era where there's no fiscal dominance, higher interest rates should lower inflation because you're softening private sector credit creation and you're strengthening the currency from the perspective of foreign investors. But in a high public debt fiscal dominance regime, higher interest rates are not always negative for inflation because although they do put downward pressure on some of those private sector things, they put upward pressure on the fiscal deficit due to higher interest expense. And that's partially what's fueling inflation in the first place. That interest expense by the government is someone else's income, right? So for example, if I use myself as an example, I have a fixed lock-in mortgage and I have money markets. If they increase interest rates, they increase my income, which I can spend, right? And I'm not the only one like that. There's many corporations in that position. There are many households in that position, ironically. And so if the private sector termed out their debt and the government has not, and specifically that those levels are very high, that's where it starts to get a feedback loop that is not in line with what the past 40 years have been. And to answer your second question, why are they spending so much? I would say, I mean, a lot of it's locked in. It's demographics. It's political. It's a gridlocked Congress. It's military spending. It's geopolitical. It's all the above. But I think the broader, more structural thing is that over the past 40 years, there's been constant deficits for the most part, rising debt to GDP, but that's been offset by 40 years of declining interest rates. And so interest expense was never really a problem. If you double your debt, but you cut your interest rate in half, then your debt servicing costs are not really a problem, right? And so it's been 40 years of that math happening. And the problem is that if you are continuing to rise public debts and deficits, but your interest rates go all the way to zero and bounce off zero and then start going sideways to up, you no longer have that offset anymore. And so I think that's the bigger factor for what's happening is that the kind of the natural conclusion of decades of deficits and debt accumulation is that we kind of enter this new period where interest expense starts to actually matter and they start to enter this kind of long-term fiscal spiral, which again doesn't mean anything major happens this year, but it means that this overall kind of fiscal train is not going to stop anytime soon. And it's this new background structure that as investors or any of us operating the economy have to contend with, that it's a different background structure than the prior decade.
I've noticed just by looking at the chart that the federal surplus or deficit, in this case the deficit as a percentage of GDP, has continuously widened over the last 40 years, like you've mentioned, Lyn, but has accelerated in its widening since 2008. And so if you just look at the charts, well, you would say to yourself, since 2008, the American stock market has seen the longest bull rally or market in history. Correlation, causation, who knows? But certainly a deficit doesn't hurt the stock markets. In fact, a widening deficit has boosted the stock markets. So just on the surface, I may make the argument that as an investor, I may want the government to spend more money, stimulate more, widen the deficit, because that's good for assets and nominal values of assets. Would you agree or disagree?
I mean, from an investor standpoint, probably, especially in nominal terms. I mean, in emerging markets, when they go through issues, usually things go up in their local currency term, even if they do poorly in dollar or gold terms. And I think what we're generally seeing is some of these developed markets, especially the US, have certain emerging market characteristics, just to a less extreme degree. Um, and so if I had a view that they were going to dramatically cut the deficit tomorrow, then I would invest differently. I would own things like I would own more bonds, for example. I would own more of those types of assets, and I would own less equities and less of these other real assets. But because I don't expect them to do that, I invest the way that I do. So yeah, you could say it's bullish on the assets that I want to own if those deficits continue, but that's why I've invested in them in the first place. It's a higher nominal regime overall. Um, and it can sometimes lead to a higher real regime if you're kind of sucking monetary capital out of other countries like places in Europe or places in Asia, for example. If the US is running this playbook, but investors are still fueling it because they don't know where else to invest, the risk comes when they do feel like they have alternatives and this spending's still locked in. And so if you get a repudiation of the bonds while this is still happening, they don't really have a way to slow it down. That's where you could get more obvious inflation risks or things like that. So it's one of those things where in the early stages, it does feel pretty good. And it's the later stages where, yeah, you really get the consequences from doing that. But yeah, I do think that overall, investment decisions have to take into account the deficit, and part of why I'm long certain assets is because of that. And the last point I would make is that the challenge when they get to these high debt levels in this financialized of an economy is that even if they try to do austerity, even if they try to say raise taxes and cut spending, that would be bearish for a period of time. But then the problem is that tax receipts are so heavily correlated to asset prices now because you've become so financialized that by cutting that, you would likely depress asset prices for a period of time, which would then ironically increase the deficit again. And so it's actually a very hard tailspin to get out of fiscally when you have the combination of this high public debt built on this financialized of an economy. If you had one or the other, it's easier to do. If you have a financialized economy but not a highly indebted one, you can start to definancialize it gradually. If you have a highly indebted public sector but it's built on a non-financialized economy, then austerity might give you options to deal with that. But if you have that combination, that's super hard to work with, especially when you're trying to work with it with a gridlocked Congress. There's really not that many outcomes I see that change that, which is why I invest structurally the way that I do.
Okay. Is there a Goldilocks scenario in which the government spends money and perhaps widens the deficit, but we don't get inflation to run out of control? In other words, MMT, in a scenario in which we have stimulus, which would be good for equity markets in nominal terms, but we don't get a runaway inflation. Could that happen?
So that would happen in the context where energy is abundant, right? So a lot of new energy supply is coming online to kind of keep up with that. And two, you have deflationary offsets from things like AI or other tech. So for example, if you ran very, very large deficits, but those, for example, if you ran very large deficits, but you used it to, go get copper mines and build nuclear plants and data centers and things that were highly productive, it might or may not be as effective as the private sector, but at least you'd bring new supply online at the same time as you're debasing your currency, so you can minimize how much on a kind of a per currency basis these things are getting more expensive, if at all. The problem comes in when you run this big fiscal deficit, but it doesn't go toward increasing the supply of goods and services. It goes more toward consumption or more toward locked in demographics or towards war or things like that. They're not really kind of fueling that real GDP growth. And so it to the extent that AI or energy abundance helps keep CPI down, but you're still running these big deficits, then that inflation will generally show up in asset prices. It'll show up in things like gold and Bitcoin and high quality equities and high quality real estate. That's where that inflation will show up. Whereas if you do get energy bottlenecks or AI does not offset things as quickly as some people expect, then more of that would show up in CPI. And you'd be a little bit more careful of some of those, high multiple growth equities, for example. So if you're not sure about this kind of the ratio of where that inflation will end up, then one thing you can do is kind of invest in the middle, which is to say own things like gold and Bitcoin and energy stocks, for example, and kind of high quality assets like that, but still be cautious around the most highly valued growth equities that might get punished if some of that inflation does show up in the CPI.
So let's talk about energy first, because you've mentioned that several times throughout the interview. Why is it that you think energy will go up? Well, in other words, why are you bullish on energy this year?
So I think that overall, we've got increasing demand for energy. Supply is not terrible, but it's still relatively tight. Companies are not heavily incentivized to invest in new production. And so I think that overall supply is going to be kind of relatively constrained. I think that shale oil is going to grow more slowly in the coming years than it did over the past decade, and that there's going to be a price increase to bring in more capex to kind of bring in new supply and kind of incentivize that longer term development of these energy resources. I also think that over the past 15 years, the type of tech we've had has been relatively disinflationary. So, for example, mobile devices, social media, these are not particularly energy intensive things. If anything, they dematerialize a lot of the other things we have to use. Whereas outsourcing a lot of high computation thinking, so making art, making videos, making complex decisions, that's actually pretty energy intensive when we kind of put that into the tech sphere. It's more of a combined software and hardware situation. So I do think that we're going to see more energy demand out of things like data centers. And then that's going to be challenging to meet. And then you need to do things like you need to increase the electrical grid capacity, which is ironically an energy intensive thing to do, a materially intensive thing to do. And so I think that the overall long-term demand is still up, supply is mixed. And we've generally seen energy kind of oil prices and gasoline prices kind of bounced off their lows a couple times and headed up. I think, my guess is that the lows are in. Maybe retest them again, but overall, I think there's more upside potential than downside potential. But then the second part of the investment thesis is that even if energy prices don't go up as quickly as I think they will in the years ahead, and they're on the more bear side of a kind of like sideways trend, a lot of those companies are cheaply priced even for current energy prices and have good balance sheets and spend most of their capital on returning it to shareholders. So they kind of keep their current situation, but they're not aggressively trying to expand. And instead, they buy back shares, they pay dividends, they improve their balance sheet, they decrease their net debt. And so that's basically a positive carry outlook, which is to say that even in a middle of the road scenario, I think those investments are still attractive compared to things like T-bills, basically compared to monetary alternatives.
Which forms of energy will likely benefit the most from the rise of AI and the need for more energy?
So I would say across the board, oil, gas, and uranium, basically. I think that um, with those types of things, variable energy sources don't necessarily cut it. You need consistent energy sources, and you need an uptick in overall grid capacity, which uses a lot of materials and is built by machines using hydrocarbons. And so I think it's an all the above situation. I think we will see more solar and wind coming online, but I think it's those more in control or base load types of energy sources that will also continue to be in demand. So I think across the board, higher energy across the board.
I've heard the possibility of Bitcoin mining producing energy that could be sold to the grid. Is that something that you're looking for?
Well, so what Bitcoin mining does is it soaks up stranded energy. So when the supply of the grid is fluctuating, right? It's some if it's solar and wind, it's obviously fluctuating based on those conditions. If it's hydro, it's fluctuating based on rain. If it's nuclear, it's always on. So either way, you have this kind of always on or fluctuating supply of electricity. And then on the demand side, you also have fluctuating demand. So during the day, there's different cycles, and then during the seasons, there are different levels of temperature and things like that. And the problem is that grids have to be designed for like the hottest day of the year. Like when everybody has their air conditions on, when everybody's using peak electricity, they have to design for that day to hopefully not have brownouts, which means they have to overbuild for every other day. And so you have this kind of you have these kind of two sine waves of supply and demand for electricity, and they're always dealing with like a potential mismatch. And so sometimes they're shutting off energy sources, sometimes sometimes they're having brownouts. It depends on the grid we're talking about. And one thing that Bitcoin mining is it's a very flexible demand source. So, when energy pricing is cheap, they can be operating at full speed. But then as soon as energy pricing gets expensive, either because some supply went offline or because there's been a surge in demand, they can throttle back their demand because they're in the most flexible position to do that. Obviously, if you're a hospital, you can't change electricity based on pricing. And even if you're doing something like you're a manufacturer or you're running an office, you can't it's much more disruptive to change your electricity consumption based on grid pricing or grid shortages compared to if you're a Bitcoin miner and you structure your contract to say, look, we're going to get the lowest cost, but we're going to be the first in line to turn off whenever there's a issue. And that's how they structure that, or they sell it back to the grid. There's also things like, the World Bank estimates, if you look at their estimates for how much natural gas is just flared into the atmosphere every year, it's something like an amount of energy that can power the Bitcoin network 8 times over, or how much methane leaks out from landfills into the atmosphere, right? So basically, there's a unfathomable amount of just stranded energy out there, and over time, Bitcoin kind of fills in those gaps. It takes a couple cycles to do so, but we've already been seeing it do that. And I think that trend's going to continue. I think it just becomes an embedded part of the grid. And that anytime you have any sort of variable power or fluctuating demand relative to steady power, you're leaving money on the table if you're not if you're not using some of that to mine Bitcoin. Because if you're getting zero or negative cost, negative revenue for your energy, then you're leaving money on the table.
On that note, let's finish up on the Bitcoin and gold price. First of all, do you think Bitcoin and gold moved up for more or less the same reason this year?
I generally think so. I think we've generally seen improving liquidity. A lot of it's fiscal driven, and so I do think that they've resisted the fact that yields are higher, right? So normally when you see yields and especially real yields this high, you should see gold a lot lower than it is. And so I think that gold investors have been sniffing out some of those fiscal problems that I've been talking about. And in addition, because of kind of decisions by central banks to diversify their reserve holdings and have more gold in their portfolios, that's been another huge factor as well. So especially from that foreign component, there's been a lot of demand. And so, Bitcoin's obviously had somewhat similar catalysts. It's heavily tied to liquidity. It's had catalysts from the ETFs and things like that as well. So the reasons that both of them are rising, I don't think are perfectly overlapping, but I do think that they are following liquidity, and which is largely a fiscal driven phenomenon.
If you were to add stocks to that equation, so stocks, Bitcoin, and gold have all been rising to new highs this year. Would you look at that and actually be concerned at the current economic environment and say, well, maybe this is not sustainable because this is not something we see very often to have, counter assets rising in tandem? Does that thought ever occur to you?
Yes, but that's generally what you see in emerging markets when they have fiscal problems or currency problems. It's just not to the same magnitude you see in those environments.
So it's a byproduct of fiscal problems, not.
I think what we're seeing is the denominator is going down more so than some of those assets are going up outside of the big bubble ones. And I would be concerned about some of the major stock indices because of how concentrated they are into some of the most expensive growth names. And so I expect the fundamentals of a lot of those growth names to probably do pretty well. It's just the question of how much you pay for them and how much of US household net worth is already stuffed into equities. So I do have concerns about them all continuing to rise together. But I think that overall, the reason that those assets continue to surprise to the upside is because of that fiscal backdrop. If you were trying to short assets in an emerging market in a local currency, you're going to continually get headwinds from the fact that that currency is so weak, right? It's just that currency is going up in supply so quickly that the assets that you're denominating them in might not be doing great in real terms, but they're certainly doing fine in that local currency terms. And, we're not anywhere near that level, but it's directionally a similar problem. When you have this kind of unrestrained fiscal spiral that's kind of just a slow motion background situation, that just changes how some of these assets are priced. And it doesn't mean you can buy things at any price, but it means that when in doubt, the answer is that scarce assets will go up in price relative to currency units.
The Bitcoin halving, that was not something you brought up. Was that in part of the equation at all, the anticipation of the halving, or even going back to early January when the Bitcoin ETF was approved? How much of a factor did those events play?
I think those are both factors. I think the ETF unlocks, there's pools of capital that are very big that have not been able to access Bitcoin. And so those pools of capital can increasingly access Bitcoin. And so that's kind of pent up demand for exposure to the network that they now have exposure to, or at least, and they don't even all have it yet. Sometimes it takes months for those things to still get approval to start moving in and start to become normalized in those environments. So I think that is a contributor to price. The halving, certainly in a sentiment sense, can raise expectations. I think that overall liquidity is a much bigger impact on Bitcoin price during bull markets than the halving itself. Because if you do the math for how much supply the halving takes off the market per day, it's relatively small compared to what you can get from ETF inflows, or relatively small compared to what you can get in one-way kind of net exchange volume in a given day. And so the overall changes in external demand for Bitcoin play a bigger role than just the halvings during bull markets. I think where the halvings really matter the most is during bear markets. They play a pivotal role in why each cycle gets higher highs and higher lows than the one before it. But in terms of the timing of bull markets specifically, I generally point more toward liquidity and less so toward the halving, even though the halving is a very relevant kind of longer term factor.
And so, putting everything together, do you anticipate Bitcoin to continue to outperform the other assets this year?
So for this year, I'm less certain. I prefer a 2-year view on Bitcoin. So I think that Bitcoin's likely going to do well over the next, call it 2 years. Um, it can get through periods where it's overbought, right? Where you could have a pretty poor 3-month period with Bitcoin, and it could underperform almost everything. And then it could have another 3 to 6 months of spectacular gains. And so my view is generally looking back from late 2025, I'd be surprised if Bitcoin was not higher than it is now, notably, and that probably outperformed other kind of large cap things you can own. But you have to account for the volatility, and you have to kind of be prepared for that really uneven path to get there.
Okay. And finally, on gold, similar question on gold. We've seen that gold and the real interest rates have been negatively correlated throughout history. Obviously, recently in recent months, there's been a huge divergence. And so how sustainable do you think this gold rally, given this historical correlation, has broken down?
So I think that because we're now in this kind of fiscal dominance regime, higher interest rates fuel the deficit even more, which potentially fuels gold. I think you could get liquidity, like temporary liquidity shocks, if, for example, you run these big deficits, the Fed tries not to monetize them, and you get kind of like a temporary liquidity problem in treasury markets. That could certainly contribute to a gold sell-off temporarily. But I do think the breakout has legs to it. I think that the breakout is real. I think that it's based on fundamentals. I think that there's a good reason that a lot of foreign investors want to own gold more so than treasuries. Um, and that they want to basically have a better ratio of gold to treasuries. And I think that that's probably going to be a longer term story. And I have no view on what gold does in, say, a 3-month period. But I do think it's now that it's broken out, I think that's a very strong sign that I think it's probably headed higher in the next few years.
Okay, and before we go, tell us about your book a little bit. Broken Money came out late last year. Congratulations. which theme or themes of the book would you say are most relevant in today's economic environment?
I would say two. I would say one of them does focus on this fiscal dominance topic that I've talked a lot about here. If you're confused by about some of the things I said as it relates to fiscal dominance, some of the chapters in the book, for example, lay out specifically what I mean and how those situations materialize over time. So kind of that long-term cycle of how fiat currencies work is a big theme. I think the other big theme touches on Bitcoin and stablecoins in the sense that they show the structural change that they brought to the monetary system. So what the book does is it focuses on the past, present, and future of money through the lens of technology. And a common theme you see in the book is that almost every friction in money for centuries has been solved by another layer of centralization. So when people wanted to send money to each other faster, they would tie into a bank and use that as the middleman. If banks wanted to send money to each other, they would tie into a central bank. If central banks want to tie into each other, they tie into an even bigger central bank. Like, back in 1800s, it would have been the UK. Now it's the US. And so you kind of have like just centralization all the way down. And what basically the way to describe that is ever since the telegraph was widely deployed in called the 1860s, you've had this environment where before then transactions were slow and settlements were slow. And so middlemen could only really do so much. Whereas in the post-telegraph environment, you can send information around the world, and now you have fast transactions, but you're still in an environment of slow settlements. Things like gold. That's like a slow form of settlement in a telecom era. And what Bitcoin and stablecoins do is now you have fast settlement and fast transactions. And so the power of middlemen potentially diminishes back down to where it was, ironically, before the telegraph, except now the whole thing's faster. And so I think that's a macro theme that's relevant as we see the current environment of 160 different currency monopolies all trying to compete with each other. They've all been reliant on having pretty closed capital borders. And these technologies just break those borders open, allow people to bypass them, allow people to do global settlements and rely less on middlemen. And I think that has long-term macro implications for the structure of the financial system and the strength of some of these currencies.
Excellent. Well, thank you very much, Lyn. Where else can we learn about you and your work?
People can check out lynalden.com. That's where I have a lot of free articles, free newsletters, and a low-cost research service.
Okay, and your book, once again, is called Broken Money, Why Our Financial System is Failing Us and How We Can Make It Better. We'll put a link to the book and to your website in the description down below. Thank you very much for joining us today, Lyn. We'll see you again soon.
Thank you.
Thank you for watching. Don't forget to like and subscribe.